Welcome to General Principles, where we chat to the makers and creators who inspire us and explore alternative perspectives on entrepreneurship. I'm Anna McGovern, and with my dear friend Daniel Jang, we speak to Hamilton Keats, a fintech founder who started a fund in his 20s. He also makes kick-ass Guy Ritchie-esque YouTube videos on personal finance. In our conversation, we explore retail investors versus institutions, Wall Street bets, why he wrote a kids' book on Amazon, and personal finance strategies you wish you would have known sooner.
Coming back to a bit of your work that you've done, you wrote a book on seeking Azores.
Yeah, I did.
A little fairy tale book. And I think you were inspired to do that based on a TikTok video.
That's true, yeah.
Particular reason as to why you decided to write a book, and what's the meaning behind Azores?
I was just I'm always looking for good ideas for videos that I can create fun content around. And it was a great opportunity. Someone sent this TikTok to me where this guy said that you could make $100 per day passive income writing a children's book. And I see this stuff all the time on TikTok or YouTube, and it always blows up and people get so excited about it. And I wanted something I could call bullshit on, because everybody knows as soon as there's an opportunity, it's no longer an opportunity. But I didn't want that to be a reason not to do it. I wanted to show people, hey, you can actually do this, but how much money will you actually make out of it? And that was the first part of the video. How quickly can you do a video? So the video was about proving the concept and inspiring people to take action. And the follow-up video will be, well, how much money did we actually make out of this? Was it worthwhile? And people don't know this, but I've actually since written 3 more books, which I'm going to be publishing.
Was that because it went so well then?
I wouldn't say, I don't want to spoil the surprise before the next video. I wouldn't say it went well. You know, we discovered that you can't really compete on Amazon when there's a low barrier to entry with Amazon ads. But the way to win is with a series of books and focusing on SEO.
Interesting.
And at the same time, I really enjoyed doing it. I thought I can actually finish one of these in 2 days. So why don't I set myself a target of doing 1 a month for the next year and write an entire series of these, and then just keep pushing out the content so that people can see exactly how it started and where it goes over time. And if it makes money, great. Otherwise, who cares? I'll be the author of, 14 or 15 children's books.
Yeah. And so this project, I presume, is more for the content to show people, or is it actually, obviously it's always nice to make a bit of money, but it's the content rather than
it's about the content, right? I want Azores to be about inspiring people to take action, because most people will look at these things and think, wow, $100 per day passive income, and they'll dream about it, but they'll never actually sit down and write the book. So I said, we're going to do this. We're going to do it within a week. I've got a company to run. It doesn't matter. I'm going to take the time and do this. And we smashed it out over the course of a weekend. We put the pressure on my designer to get the illustrations done and put the book out on the Friday that we posted the video. So we were making the video and writing the book and doing everything else on a day-to-day for that week. It was exhausting, but it was very rewarding to come to the end of the week and have all of that out.
Are you still getting much organic traffic from people buying the book?
We get a lot on, I think it's KDP. So you can make your book free to people that have a subscription to KDP. So we get a lot of free reads. I wouldn't say we get loads of sales because we turned off the marketing. But one of the areas that I've seen with the biggest potential on Amazon is in the SEO space. So you've got to, you see a lot of the most successful authors or young authors starting out are keyword stuffing their titles. So you can look at a high volume search term like something to do with dragons or with a traditional book like Harry Potter, and they'll put a spin on that, stuff the title and subtitle, and that will get a large volume. It wasn't something that I wanted to do because of brand, but it's something that I'll talk about, and it's something that we'll work on throughout the series. So we got to writing book 3, and I started to write about dragons. Let's incorporate dragons.
Yeah, I've not tried KDP, like Kindle Direct Publishing myself, but I have published onto Amazon under like a pseudonym.
Yeah.
And essentially, I guess my book was pretty much rubbish. I just did it for fun and I wanted to kind of troll someone. So essentially, it was probably like a 3-page book that was just rubbish. Like it actually didn't make any sense. And I think I have made about $1 in profit. So it sells. And I think it's still there.
You laugh, but it all adds up, right? And the more you do, the more traffic you get to it. So if you wrote 20 books, you're actually getting more volume of more search volume directed to those earlier books, especially with the series, and it becomes exponential. It's a compound effect essentially with purchases, as you would if you made an investment into anything, and that's what I love. But it's funny you should say that you're trolling someone, because the entire series on the adventures of Azarus that this book is about is trolling other people. So in book 2, you'll learn that we're trolling one of the co-founders of one of our competitors in the UK. So we make him one of the evil characters, and we're just trolling everyone we can, the regulator, the incumbents in the investment space.
Tell us a bit more about your background before writing the book. And I think you've got a background in finance. So what have you been up to and how did you kind of start getting into the finance space?
Oh, that's a long history. So I'm 33 years old, been in the finance game for over 10 years now. I studied physics at Imperial College here in London, and then took the standard route was just to dive into finance. Everyone went into finance. If you studied physics or maths, you went into investment banking or trading. So it was no surprise that I should end up there. And I spent about 2.5 years working in investment banking, corporate finance. I absolutely hated it. Not necessarily because of the job, but I hated my manager at the time, who was obsessed with FaceTiming and I think being away from her husband, because she liked to stay in the office till like 3 or 4 a.m. And of course, being the junior, I had to stay in there. And so in the end, I just upped and left that investment bank. I went to join another bank, had a bit more relaxed time on the trading floor, building technology for different trading teams. And then finally, I found an opportunity to start my own thing, which I'd always been keen to do, in the background. And I was one of the first guys to be doing equity-based crowdfunding in the UK. So I was the third to be regulated in the UK for that. But the market never really took off in the way that I thought it would. So I was always looking at other opportunities in the fintech space. And finally, I decided to delve into the asset management space and ended up joining a investment management company in London here, which is an interesting story. I'll have to do a full video on it later on, because it was really a rapid rise and fall over the course of several years. We started from scratch. I recruited friends of mine from Imperial and Oxford as my co-founders. And we went from nothing to about 2 million a year in revenue. And ultimately, I walked into the office one day and found that I was being dismissed as CEO by the major shareholder and director just on the spot, because it turned out that they were going bankrupt and they wanted to rip out as much as they could. So I found myself having built up, burning through my savings to build this company, get it to 2 million a year in revenue, and then suddenly it just collapses around me. And after that, I was looking for the next kind of thing to do. It was almost survival mode. When it happened, I had a trip planned to Tokyo the following day with my partner, which we had to cancel the flights and the hotels 12 hours before and kind of immerse ourselves in this battle and rebuild from the ground up. And since then, I've spent my time building a lot of B2B infrastructure. So infrastructure as a service in the finance space. We have several thousand clients under that banner that we offer CRM services to, trading, clearing and settlement, and so on.
And coming back to one of the points that you made, that they could just kind of come in and fire you as the CEO, does that happen often, or like how did that situation just come about?
So it was building up over time. I was very naive, because you've got to bear in mind I was only in my mid-20s at this time and I'd never experienced this. And my mindset was always the growth mindset. I love what Daniel Priestley in the Entrepreneurship Revolution calls the empire mind. rather than you having a monkey mind where it's all about scarcity, an empire mind is about abundance. And when it comes to building a business with your relation, or you have a relationship with your co-founders, you're not greedy. I was always, there's enough for everyone to go around, because if you demonstrate value, people will want to continue working with you. So everything was very much handshake driven, or, you know, have faith in the contracts and so on. And when you're doing everything on a shoestring, sometimes you don't lawyer up front. So you're reviewing the agreements and you can get shafted quite easily. So at this point in time, I had less than 50% of the company and I didn't have control. And I found myself being ousted by the majority shareholder overnight.
Wow. And there was no legal recourse or anything that you could do?
It was a big legal battle. You know, I was kind of still in shock. It was my first time entering into a litigation situation.
Right.
Over the course of 2 years, it ended up costing me 6 figures just to defend myself, and this not even being on the attack. But they ran the company into the ground. They did it on purpose, because several months beforehand, they'd taken on a huge amount of debt. They couldn't afford to pay the coupon. They tried to urge me to take, we were managing client money. We were at about 150 million there. We were growing at 20 million a month in assets. And they were trying to force my hand to invest client assets into their companies. Myself and my colleagues in the business just turned around and said, you're absolutely crazy. They tried to do it subtly at first and became more aggressive and more bearing. And ultimately, I found myself straight out the company. It was timed very well. They knew that I was off to Japan the following day. So you've got to be wary of who you partner with. And I think one of the biggest signals was, if you've ever read, what's the name of it? Jim Collins' Good to Great. He talks about people that go into companies, and I think there's one CEO that he finds taking the stamps off of the mail to recycle them. So I've always looked for, who's doing that. And in this situation, the shareholders of that company were all driving around in £150,000 Range Rovers, going clubbing every night. And here I was, sweating and, trying not to spend money to grow the business. Even when we hit 7 figures in revenue, I didn't want to spend anything. I just wanted to roll it all back in, because I was like, let's just grow this. I thought we could hit 1 billion within another 18 months. And we were on track to just scale super fast. Everything was going great. But what you don't realize is that they're doing this with debt. They're not doing this. They've not had success, and they're living beyond their means. And you have to identify that first, really.
Right. That's quite interesting. Do you think in hindsight you would have done anything differently, or in terms of like management, would you have structured the company a little bit differently so that they couldn't do what they have done, or would you?
You learn a lot. I call it my PhD in business, because since then I've learned you pay the money to lawyer up. It's not necessarily that lawyers get things right, but if they do get it wrong, then at least you can sue them, because they have the PI cover in place. And also make sure that there are always agreements up front and signed. We let a lot drag out early on, because it was very much, okay, we'll do this, this, and this. Okay, we'll get it turned around. We'll sign the agreements later. A lot was done on faith, but even when it was signed, ultimately I lost control. And now I'm very keen on never giving up control in anything that I do. It doesn't matter. I don't mind giving up equity, but I'll never give up control.
So how much equity do you tend to give away? Because you mentioned, I think with, say, when you're writing the storybook, that instead of hiring people on like Fiverr or Freelancer, you partner up with different people and you give them a part of the pie, but then you don't have to pay them.
It's always preferable to do, because you learn along the way. You can end up spending an absolute fortune on different services. Like if you look at the design, we spent probably 40 or 50,000 pounds on our design and branding early on. And then we were fortunate enough that the founder of Brilliant Path, who's now my partner on Azarus, looked at the business and was like, look, I absolutely love this. I love what you do, and I want to be involved in long term. So how about we find a relationship? I don't want to give away too much on what that is on Azarus, because it wouldn't be fair to everyone involved. But in general, when I'm doing something, if people are full-time, I will never try and take the whole pie or the majority. I'll just say, right, look, we split it down the middle. So in my last company, there were 3 founders initially, and I just said a third. Now, occasionally you can get that wrong if you don't structure the vesting schedules appropriately with a cliff and have clear deliverables, then it can go wrong, which I've learned over the years. But more or less, you get to know people over time and you find the kind of people that you want to work with, definitely, as long as you are of an empire mind and you know who's going to deliver value. So I've got a great team around me now that I know they are going to continue to deliver and they're in this for the long haul. And knowing that and knowing them for such a long time, you know, I've known my co-founders on my other business for over 10 years. We're talking, you know, 15 years now, it must be. Over that period, when you work with someone that long, you know, when you set up a new company and they're in it full time, you can depend on them.
Yeah, there's a level of trust that you have kind of developed over time and you do know how they work. In
But
terms
it still has to be written down. There still have to be clear deliverables. Like I'm having a conversation, which we're hiring for a COO in my other business now. And I'm having a conversation. I'm really desperately trying to lure my partner, Kim, in to come and take that role. And even then it's very much, you know, this is my wife essentially. And we're still having this conversation about what are your deliverables over the next 4 years? What's your vesting schedule? That's how you have to be. And you only learn that by getting screwed.
Right. Interesting. That's quite interesting because I think before Kim was in Antler, right? And she was kind of going into like the future of browsers, but now she's joining you in.
I've been working very hard, Daniel. Trust me. It's tough to recruit good people and good people make a company. So if you can find someone that you trust to work with, you do everything you can to get them involved. And you know, going back to that empire mind thing, you know, it doesn't matter that she's my spouse. I still turn around and said to her, I'll give up half my equity to you to come in now. And you know, this is an established company with several thousand clients, but I'll still say that because I trust her to deliver. But at the same time, you want everything in place so that people are incentivized to do that and they have clear goals that they have to hit over time.
Yeah. And have you ever thought about any like conflicts of interest in terms of like having someone really close to you within the business? So I think generally a lot of people are a little bit cautious when it comes to very close friends or family members just because of they want to separate, you know, work life and personal life. Or do you have like a mechanism to deal with that type of, if conflict arises, things are going to go completely shit?
Oh, absolutely. The one thing I would say is I'm very lucky in that most of my friendships are founded on business. So they're not businesses founded on friendship. And a business founded on friendship would scare me. And I've always looked, it's going to sound really, really shallow, but I've always looked for people that I thought that I could work with because I've had that kind of one-track mind of, I want to build something of scale. So all of my closest friends are really highly ambitious entrepreneurial types. And you even see that in Kim, you know, she wants to build something of massive scale. She's not interested in taking a job with an established company and just petering along.
Currently, Azores is focused on personal finance, mortgages and things, right?
Yes.
What are the main problems in that space currently?
I think we're seeing a lot of those problems play out live right now, aren't we? One of the biggest problems that I personally see is consumer behavior. And this isn't to say that it's not tough for the modern generation. It is hard. If you look at historic generations on one income, they could afford to buy a house, a car, have holidays, and so on. And people talk about inflation like there's never been any inflation. Of course there has been. It's just not in things that we recognize. You can't, if you're earning, I don't know what the average salary is, maybe 30, 40,000 pounds. How are you going to buy a house in London? A studio flat around the corner from me right now is worth about 500,000 pounds a year. But if you're earning 40,000 pounds a year, they'll only lend you 4.5 times your salary. So 160,000 pounds. Well, it's just impossible. But at the same time, people are complaining about not being able to buy things or invest. And yet they'll go out and they'll have a brand new iPhone or they'll be buying new clothes every week. So consumer behavior is one of the biggest problems in that respect. If we look at the broader market, then I'd say what we're seeing play out now is a problem with centralization and decentralization will probably be one of the biggest trends over the coming years. And I don't want to sound like one of those crypto bros, because I'm not, I do have some crypto, but I'm not like a pomp who just kind of tries to pump Bitcoin daily on Twitter. That's not me.
Yeah. But in terms of what is happening right now, do you think there's also like a shift in terms of, I guess, current modes of thinking on how one should manage their finance? So with Gen Z, for example, I know that a lot of Gen Z people tend to be very bullish on crypto, whilst traditional investors or more older generations are like, where's the value in this cryptocurrency, and what if things goes wrong? Have you considered that perhaps personal finance is undergoing like a pretty good revolution or so at the moment?
I think it's fantastic, right? It's great to see people interested and excited about investing. All of this press that it's getting is phenomenal, because people are going to start thinking about where their money goes. Whereas traditionally it was down to, you just set it and you forget it and you put it into passive funds. And there is a paradigm shift undergoing right now. And it hasn't helped in the past that people didn't care about it, because if you take the pension market, which is one of the most heavily regulated, but it's also one of the most obscure, the stuff that goes on there is scary. Anything prior to kind of 2014, 2015, you're getting shafted in terms of fees that you're being charged. I was looking for a family member at a money market fund that they had, and for something that costs, we're talking 0.1% probably, they were paying 2%. And
Wow.
this is the norm. So I think it's fantastic that younger generations are getting excited about managing their own money and investing. There also is a bit of a danger to it, though, because you could, the likelihood is that we will end up in a bubble that bursts at some point. But what can you do? The Fed in the US has pretty much driven this speculation frenzy by handing out stimulus checks and turning on the money printer.
Do you think we're currently in a little bubble, like another like .com 2.0?
Oh, without a doubt, there's no value in these stocks. It's pure speculation. If you look at something like AMC, for example, theaters are closed, right? I think the top box office last year or pre-pandemic 2019 was around 800 million. So if you put that at a kind of 5 to 10 times multiple, let's say 8 times, that would be a $6.4 billion valuation. And, above $8 per share, $7-8 per share, it just doesn't make sense to be in AMC. And theaters are closed right now. There's not going to be any box office. So it's all about survivorship. And GameStop is really just people shafting hedge funds. They're getting excited about seeing how high it could go. When you have that kind of volatility, it's a bubble. But I wouldn't be concerned about that, because it will run. And one of the biggest mistakes you can make is not being in it, because you just lose money to inflation. And we should definitely expect inflation with everything that's going on and all of the stimulus that's coming.
Yeah. But do you think that if enough people believe in it, so I guess Robert Shiller has a book called Narrative Economics, where I suppose if a lot of people believe in something, that counterfactual event could possibly become the truth. And I think the common example that people give for that is, say, Bitcoin. If enough people believe in Bitcoin as holding fundamental value, then it starts having a bit of value. Do you think that's kind of like the new norm? If you see, say, for example, with Tesla, they at very high levels, much more value than a lot of car companies that are producing a lot more cars than Tesla. Do you think that possibly this is just going to become like a new norm in terms of how people value companies and think about the market?
I think that's something that's certainly been on my mind. You're right to say Bitcoin is faith-based. Traditional fiat currency is also faith-based, because originally it was benchmarked against the gold stores in things in the government's gold store. But since they've debased currencies, it is all about faith, and that is what's driven Bitcoin. And at one point, maybe the bubble could have burst on that, but now that institutional players are in, it's much less likely, and it'll probably continue to slide up. I'm definitely not of the kind of hodler mindset in that. I wouldn't hold on for dear life in any of those things. I'd be perfectly happy to trade on them based on the price action, but blind faith can really get you caught out in these things. Is there a structural shift in the way that companies are valued, and will that reflect in their share price? It's totally possible. It's either that, or we're seeing huge inflation. You know, the argument has been over the last, God knows how long, maybe 20 years, that tech has acted as a deflationary tailwind. So is it fair value, especially in a pandemic when these tech companies are booming versus other companies? I think only time will tell, really.
So other than Gen Z investing more in Bitcoin, are there any other fundamental changes? Because you were mentioning consumer behavior. In the next 5 years, will that become more of a problem?
That's really down to the consumers. It's cultural, isn't it? Do we want to be the type of people that YOLO, or do we want to have a bit of delayed gratification? Entrepreneurs always talk about how you have to hustle now to, work like nobody is willing now, so you can live like no one else can later. And the same thing comes down to investing. One of the best things you can do is just start investing aggressively in your early years because of the compound effect, and then you can take your foot off the accelerator. Will people's mindset shift, and will they fix their behaviors? I don't know. It's really hard to tell. I think unless there's some kind of government intervention that forces people to contribute more and forces corporations, certainly in the UK, we've had auto enrollment in the pension side of things now. And if you look at what's gone on in Australia, you have people working in retail that have six-figure pensions after a few years.
Yeah.
Governments can definitely force a shift, but I don't know if consumer behavior will, because the trouble is, it was J. Willard Marriott that said, no matter how hard you're working to make your money, there's always someone out there working twice as hard to take it from you. And that's the truth. Companies are hiring the best and brightest minds to get you to spend money frivolously.
So if you're not seeing this shift in consumer behavior, where do you expect to see the changes in this space to come from over the next 5 years?
Certainly, like, the things that I'm most excited about are probably on the B2B side, and especially in terms of infrastructure as a service, which we're seeing people like Stripe get interested into. There's a big open banking movement and looking at that, and then you've seen the rise of Plaid now as well. I'm really excited about infrastructure as a service, but that's purely a B2B play rather than a consumer play. But at the same time, if we make it easier for people to launch things like investing and trading and savings apps, then bright minds will come out and launch these startups with a lower barrier to entry, and you'll see them enforce or encourage better consumer behavior.
Well, innovating in the fintech space is obviously difficult because of regulation. How can we make that easier? Because these regulations exist for very good reasons. How can you innovate when there are these big hurdles as someone who maybe doesn't have hundreds of millions in VC funding?
Yeah, it's not necessarily the regulator that's the problem. One of the biggest problems is building the infrastructure out. So when we talk about investing, there is a regulatory hurdle and there's a capital adequacy requirement. We can't really do a lot about that. Regulators are working hard to create sandboxes that startups can come in and they'll assist them in terms of getting licensing and applications. But the biggest issue that I see is actually the infrastructure. Anytime you want to implement a new service or feature in the fintech space, you have to consider hundreds of thousands in spend for infrastructure for what is trivial. Stripe innovated by focusing on developers and building intuitive and robust APIs for payments. And I think over time, we'll see people doing that with open banking for payments, but soon to be with saving and investing as the infrastructure is built out. I'd love to be a part of that, especially with what's going on in DeFi, making it possible for that to happen. Because if you have a plug and play API that people can sign up for with no £100,000, to give you an example, I think we spent close to £500,000 this year purely plugging into third-party financial services so that we can offer new features to clients. That's insane. No startup's going to be able to do that, especially no pre-seed startup. So if people have to do that, you're creating huge barriers to entry for what is crazy. These, really trivial services like trade reporting on the investing side cost an absolute fortune, and they shouldn't, because it's such simple stuff to do. And as people develop this infrastructure that you can plug and play with, I think we'll see startups coming in and being able to just set up and deliver a new application and a kind of new shift in cultural behavior if they can encourage people to take up their apps.
Do you see any startups or know any startups who are kind of doing that right now?
Well, in the open banking space, you've got Plaid, you've got TrueLayer, I think you've got Bard and a few others. In the infrastructure as a service space, on the trading side, I think a lot of people will keep quiet about that, especially as it's an industry run by dinosaurs, essentially. I definitely don't want to shout too much about what we do in my other business, because I don't want the competition. I don't want someone coming in with 100 million in VC money and competing with me. It's not worth it. I like competing against these dinosaurs. It's a nice place to be in. You're talking about simple features that we could implement in 2 hours, which they take 18 months to deliver. And that's the type of space you want to operate in.
Yeah. And why do you think these dinosaurs aren't doing anything? If it's so simple, surely they can kind of bankroll another little startup or kind of fund a internal project to tackle it.
Why does anyone get acquired, right? It's easier to acquire someone than it is to innovate. Because imagine how many projects you have to take on to try and be right. Entrepreneurship is not easy. It's tough. So it's much easier for these companies that, they're cash cows, absolute cash cows with trillions of assets and billions in profit each year. It's much easier for them to turn around and spend a couple $100 million to buy any breakout success than it would be to spend billions on R&D. But they also create huge barriers to entry through complexity and regulation, like I said earlier. If you look in the UK as well, I think there's probably examples in the US that Robinhood faced when they were trying to grow. Like, God knows they screwed that up. Now elite Robinhood trending on Twitter. But in the UK, we saw this situation, and I've faced it personally. But one of the best examples is PensionBee, which tried to make it simpler for UK citizens to transfer their pensions electronically, faced huge backlash from incumbents like Aegon, who is absolutely massive, and tried to say that they were fraudulent and they were stealing clients' money. And eventually the CEO of PensionBee had enough and wrote an open letter, which you can read online. It's fascinating reading to see the kind of steps they took to encourage clients. But this stuff goes on all the time. If I'm Aegon and I've got someone in a legacy scheme where I'm earning between 2 and 3% on their money, and they're trying to switch to PensionBee, where they're only going to pay, 30% of that or less, probably, 3% on Aegon, 0.6 on things. So you're talking 20%. So I'm paying 20% of what I would be there. They're losing fortunes and fortunes, and they don't want this to happen. And they will do whatever it takes to crush people and then apologize about it later when they get caught out.
Yeah. So I suppose it's all a matter of like pricing and communication. If you can kind of keep your prices as it is due to having, good or better communication and convincing people that you're doing the right thing, then keep it that way.
It's also a lot about brand. So when it comes to people's money, they're really, really nervous about using a startup. You don't want it to go bust, and that's a real risk. So they prefer to be with these legacy providers. Yes, there are, regulation puts in place certain protections for investors, but people still get nervous. You don't want to get invest money with someone like PensionBee when they were first starting and they had the risk of going bust, and then your money was locked into administration and you needed to draw that down in a pension. You could never access it. So building a brand and finding the right partners that will help you to scale is going to be important. Even when they face this backlash from Aegon, State Street Capital was one of their largest shareholders. So you'll still have the incumbents trying it, but it's important that you have people in your corner that believe in what you're doing and are going to be there to fight the righteous fight, right?
Right. Do you think more regulation will come in terms of, I guess, pressure from, say, the UK or the US government? So I think with, say, in China, if we look back about a month or two ago, AntPay was going to have a massive IPO, and then the Chinese government just decided to step in because they are kind of doing some initiatives of their own. At the moment with Wall Street bets, I think you're seeing some of the senators who you wouldn't expect to be on the same side, both being against, Robinhood. Do you think there's more to come in terms of regulation now?
There's a big difference between the regulation in China and regulation in the UK or US. They can't be that aggressive. They certainly will try to be at times, but big companies will just shut them down. Big companies have these relationships with ministers in the UK and with Congress in the US, where they lobby for changes that they want to happen and lobby against changes that they don't want to happen. So it's tough. And one of the biggest issues you've got, and I'll probably see a bit of backlash from the regulator if they ever hear me say this, but they're incompetent. The sad fact is that if you can't make it in Wall Street, you go to work for the regulator, and that's what happens. And in the UK, we're happy to say that the FCA is a bunch of civil servants that don't really care what goes on, and react very badly when things do happen and have no idea what they're doing. They really don't understand the industry that they're working in. They're just not that competent, and it's sad to say that, but it is. They don't pay enough to attract the best talent.
Yeah, that's true. So moving on to another topic based on, I guess, your extensive experiences and what you're doing now. If we kind of go back to our 20s, for someone in the 20s, how can one get rich? Do you have any business ideas? Do you have any ideas in general as to what one can do?
Oh, that's a really tough one.
Like anything that you have in the back of your mind, and if you weren't doing what you're doing now, what would you kind of look to do?
It's going to depend on a lot of different variables, right? What is that person's circumstances? But I would certainly say that there's one common theme, and that's going to be taking more risk and focusing on building assets. A lot of people are kind of, like I said earlier, behavior is focused on living in the now or experience and spending money. But I would focus on building as much as I can in assets. And I wouldn't worry about cash flow. You go into a job and you want a pay rise. I'd always go after equity, because that's the way to get rich. If you end up in it's the higher example, but if you end up in a higher tax bracket, and your effective tax rate is over 50%, you've got to earn 100% to make that back. Really, the way to avoid that is not to be paid in cash. If you believe in the company you're in, take options or invest it into your pension and get the pension tax relief on it. But if I was to go back 10 years, I would go aggressively after equity for any business that I was in. I would want options and ownership, because one, you're not taking cash out of the company, so it can be reinvested in the growth. Obviously you have to believe in the future of this company. You don't want equity in shit. It's going to be worthless down the line. But taking equity means you're not paying taxes on it right now. You don't pay taxes until the company sells, or you exercise those options and you have a capital gain situation. So I would focus on equity. And people always confuse this when they say, oh my God, Jeff Bezos has so much cash, or Elon Musk has so much cash, why doesn't he give it out? No, they don't. They have equity. They literally cannot liquidate those assets, because it would tank the price of those stocks for other shareholders. They have assets, and they've built that over time, and they've not paid taxes because they've been taking, there's a reason people take up when they reach a certain thing. Mark Zuckerberg taking a £1 salary, there was a reason for that.
Yeah.
You don't want to pay taxes, and you have to start thinking like wealthy people do. Stop thinking about cash. Don't be hungry for cash. Take more risks. Get as much equity as you can, and live within your means. If someone's offering you $60,000 or $80,000 starting salary, say, hang on a second, I can live on 30,000. Give me another 80,000 in options, because I'm foregoing the cash. If that company's successful, you've just delayed the tax bill for several years, and you might 10x those assets over that period. So it's a way better way to do things.
I believe that in the US, there's also a lot of like loans. I think they're basically called SBA loans, where you can get a lot of money because the bank wants to give you money so that you could have a successful business and they kind of profit from that. Is there any equivalent in the UK or in Europe?
We don't have SBA loans here. No, I'm not sure there is. You know, we have a lot of grants. So I've never looked at them personally, but we're far behind the US in terms of like the startup mindset.
Right.
US has a way better ecosystem for investing and backing startups, and entrepreneurship is kind of more glorified in the US. We're getting there in Europe. You know, we've worked hard to be more open to backing young entrepreneurs and taking risks, but there's a better culture of taking big bets on young people in the US than there is in the UK.
With what's happening in Europe as well, do you think there's any industries besides finance which are kind of on the rise and possibly going to lead a more entrepreneurial mindset within the whole of the UK and Europe?
Oh man, there are loads, right? This is the problem. There's so much opportunity out there that when, as an entrepreneur, you got to kind of say no to a lot of stuff, because I get excited all the time about stuff that I see people doing and I want to be a part of it. And for example, if we look at the construction space, huge opportunity globally in construction tech. And if you're going not just on the tech side, but if you go into prefab or modular construction, incredibly exciting what's going on there. You're essentially halving the time it takes and the cost to deliver a high-rise building.
And what's the second? I think you've mentioned another thing that you were excited about as well.
I think, you know, for me, it always comes back to fintech, because that's my baby. It's definitely decentralized finance is what I'm excited about. And I would love to see what happens with brokers going forward, and, you know, who's developing the technology to decentralize trading, essentially. You know, look what happened with AMC and GameStop and Robinhood and Webull and TD Ameritrade refusing to action buy orders for investors over the last couple of days on those stocks, essentially forcing people to sell off and putting an end to the short squeeze to save the hedge funds. That's insane to me and should never have been allowed to happen. But I think what will happen is now people have realized, hang on a second, brokers are in control here. And you'll have people come out and say, how can we change this?
The UK is obviously great for certain areas. You get local centres of excellence. London is brilliant with insurance, or Israel's great for security tech. Like, what is something that Europe could compete with in terms of innovation and entrepreneurship that maybe the US doesn't have that advantage with?
I think finance is going to be the one, and it's going to come down with Brexit now. It's going to come down to how Boris Johnson treats the square mile going forward. They could really set the scene for being the Hong Kong of Europe if they treat it right. Now that we're not under the thumb of the European Union, and that's not to say I'm for Brexit, I voted against it. But now that we are, you know, we've got to make our own choices about what we do to bring the company forward. And the vast majority of GDP from the UK comes from the financial service sector. There's just no doubt that is what we're built on. We are a service-based industry now. We are no longer colonizing the rest of the world. We don't have a huge number of exports in terms of physical goods or commodities. We are a service sector, and that is primarily finance, and, you know, a small part of that is consulting.
We like to ask people about the mental models in terms of how they approach their business. And that's a super vague question, I know. But what guides your approach? You've mentioned a bit about monkey mind, empire mind. Is there anything else that's your mental model?
Damn, that's a tough question. I guess I always look at what is the highest value task that I can be working on. So I love the saying, productivity is the enemy of creativity. So I'm such a lazy person. I don't mind getting up at 4 a.m. and traveling 3 hours up north to do a meeting and stuff like that. But in general, I will look at the easiest way to deliver something. And that's certainly, I think that's mental model is what's the the shortest path to success. You know, like Bill Gates, I think it was Bill Gates that said, you know, if you've got a job to do, find a lazy person to do it.
So now I'm going to ask you some quick fire questions. Who is your favorite entrepreneur?
I'm going to sound like such a fanboy. It's Elon Musk.
It's what everyone says. What's your favorite book?
So many, but I think the one that stood out, really changed my, we're talking about mental models, was Entrepreneurship Revolution by Daniel Priestley.
Do you have a podcast you love?
I have a few that I really enjoy.
What's the first one that comes to mind?
My First Million, Hustle.
Yeah. That's a good one.
I think everyone loves to hear Sean and Sam shoot the shit about, you know, which idea is going to be successful.
Well, thank you for speaking to us today. It's been
my pleasure. Thank you for having me.